Dunque vorrei avere la potenza di Interactive Brokers, le loro commissioni competitive, anzi se possibile pure qualcosa meno, tipo pagare 50 centesimi per ogni ordine sulle azioni americane, e poi l'assistenza in italiano, il supporto fiscale, materiale educativo.
Ah, nient'altro? Non vuoi che vengano a casa a farti anche il cambio dell'armadio?
Davvero?
Beh, su quello ci stanno ancora lavorando. Però usando il link in descrizione entro il 31 luglio puoi aprire un conto titoli con Maxem, il partner europeo di Interactive Brokers, e accedere ad un listino commissionale unico, solo per gli ascoltatori di The Bull. Poi basta però,
This episode is brought to you by Amazon Business. How can you free up your team from time-consuming office tasks? Amazon Business empowers leaders to not only streamline purchasing, but better support their teams, so they can focus on strategy and growth. Free up your teams and focus on your future. Learn more about the technology, insights, and support available at amazonbusiness.com.
Welcome back to The Bull, your personal finance podcast. The series of incredible interviews continues, and to be perfectly honest, I've been waiting for this moment, the chance to speak with today's extraordinary guest, even before this podcast was born. Because let's face it, if you are into finance, you have to read the most venerable financial newspaper in the world, the Wall Street Journal. And if you read the journal, you have to know one of its most respected columnists, Jason Zweig, holder of the personal finance column and one of the most admired financial journalists on the planet, known for his rare ability to combine deep knowledge with remarkable clarity. Jason honored me by accepting this interview after the journal did its homework and greenlit the meeting, and we talk about a lot of meaningful things that directly touch the life of every investor, with a special focus on the deeply human side of finance. But now, without further ado, like a dwarf standing before a giant, I'll step aside and leave the stage to my guest. I hope you enjoy this conversation with the legendary Jason Zweig. Enjoy it! Dear Jason, welcome to my podcast, The Bull, and please tell me why on earth you accepted my invitation to this podcast.
Well, because you asked, and because several other people told me I should. And, under the rules of the Wall Street Journal, we always have to research any place where we make an appearance. And I did a little homework on you, and I'm happy to join you.
So this conversation is approved by the Wall Street Journal.
Well, the conversation is approved. Let's put it that way.
Would you please tell those who don't regularly read the journal what the Intelligent Investor column is all about?
Yes, so the column is called The Intelligent Investor because it's named after the great book that the investor Benjamin Graham wrote originally in 1949. And what I like to, there it is. And what I like to say to people is that it's a column about how to think about investing. It's partly about investing, but more importantly, it's about how to think about it. And Graham was very clear what he meant by an intelligent investor. He didn't mean someone with a high degree of intelligence as it's conventionally measured.
Although he was highly intelligent.
Although he was extraordinarily intelligent. In fact, he almost certainly was what everyone would agree was a genius. I mean, he was he was an incredible mathematician. He was fluent in Greek and Latin and French and Spanish and used to play Scrabble in several languages at once.
Really?
Yes.
A polymath.
Yes, and he was an extraordinary mind. But I think it's maybe the simpler distinction is that the column is not about investments. It's not about particular stocks. It's not about this mutual fund or exchange traded product. It's not about this particular bond or a piece of real estate. It's about investing as a process and as an intellectual and emotional challenge. And, I often say that 95% of my job is figuring out what not to write about. Because, the financial industry just produces mountains of information and propaganda every day. And most of it is either fake or downright false. A lot of it is full of bad logic and bad data. And so my role is to help people try to find the little bit that makes sense in the storm of nonsense.
In fact, there are many articles about what not to do when investing. You read a lot about the problems with this or that hot stock, those hot private market funds, new fancy stuff, etc. And you always try to make people aware of the importance of keeping their investments as simple and consistent as possible over the long run, instead of being caught by a brand new trend or some ultimate idea that would make you rich overnight.
Yeah, this is maybe a good moment, Riccardo, to pause and talk about two different ways you can invest. So you can I wish I knew how to say this in Italian. I wish I knew how to say a lot of things in Italian. You can invest for entertainment, or you can invest for enterprise. Like, you should ask yourself, why am I investing? And it's fine if one of your goals as an investor is to have some entertainment, to have some fun. It doesn't have to be boring, and it doesn't have to be completely conservative, and you don't have to avoid every risk. If you find risk-taking fun, if you like the casino or you like, playing lotto, you can do that with your investing. I like to think of investing as an enterprise. It's a process that should last your entire lifetime. It should be continuous, and it should follow rules and policies and procedures that make it automatic so that you can get on with the other aspects of your life without spending so much time and energy on your investing. And we know for a fact that on average, the more effort and time you put into investing, the worse your performance will be. You will generally do better by putting it on autopilot. Just set it and let it run. But if you do want some entertainment, that's okay, as long as you isolate it. You have to make sure that it's a small piece of your investing process rather than the whole thing.
The fun money.
The fun money, or as I like to call it, the mad money.
The mad money.
Pazzo, right?
Perfect.
And so the problem people get into is when they mix the two of them. When they think they're investing for enterprise, but they're actually investing for entertainment. And those lines can be very, if you haven't drawn those lines really firmly, it's very easy for you to slip. I mean, think about what happened in 2020 and 2021 during COVID, during the pandemic. Everybody was home. Nobody had anything to do. We were all on our screens all day long. And the next thing people knew, they were trading and they were buying all these, meme stocks. And they made a lot of money for a few weeks. And then most of them lost it all. And, did people learn the lesson from that? I think what the lesson a lot of people learned is I should never buy that stock again. They didn't learn the lesson I should never speculate except with my mad money. And they're doing it again. We see it with crypto. We see it with, a whole bunch of other stocks. Gambling has become mixed with investing in ways that are not healthy and are not going to work out well for most people who try it.
Yeah. In the last few years, at least up until February the 19th, when the S&P 500 peaked, it was very easy to fall into this trap because the market went up almost in a straight line for a very long time. You could invest in high-growth stocks, in Bitcoin, in gold, whatever, and you were going to be fine. It's understandable that you were tempted to think of having some kind of gift in managing your money better than the market average. And when the market is completely risk-on, that's the most dangerous period you may find yourself in, because you are prone to think that everything will always go up forever.
Yeah, as you know, Riccardo, I spent 2 years working with the psychologist Danny Kahneman on his book, Thinking Fast and Slow. And I remember one day he said to me, the most important question people should ask in life is, what is the base rate? And so what that question means is, what is the average experience, the average historical experience of people trying this? And what you need to understand is during a long bull market, the base rate is positive. Everybody is making money, not because they are all good investors. They're making money because the market is going up. And if during that period you start to pat yourself on the back, and say, what a great investor I am. Look at all this money I'm making, without taking a moment to look around you and realize, the stock market is up 25% and I just made 20%. So maybe I'm actually not that good an investor. Maybe the market is making money for me. I'm not doing it. It's not me. It's the market. And when markets go up very, very fast, the way they did in, say, 2021 or in 2023 and 24, when stocks do very well in a short period, it's hard for people to say, it isn't me. because they feel their wealth growing and they think, I'm doing it. This is the result of my actions. When in fact, it's happening because other people are willing to pay more for stocks. It's not that you picked the right stocks. It's just that all stocks are going up because people are feeling optimistic about the market as a whole. And so you must take the time to separate the effect of your actions from the effect of the market as a whole. And the single greatest contributor to any investor's returns, including Warren Buffett, is how well the stock market as a whole is doing. It's much more important than you, whoever you are.
In The Intelligent Investor, there are a lot of timeless lessons that go in this direction. Now, you can't think of The Intelligent Investor without considering your commentary to the book, which is part of the book itself. In the preface, you pinpoint 5 principles from Ben Graham's book, and one of them is that the market is a pendulum that forever swings between unsustainable optimism and unjustified pessimism. The Intelligent Investor is a realist who sells to optimists and buys to pessimists. What can we learn from this idea that was written back then in 1940, 1950?
1949. Yeah, so I have the same answer to this that Warren Buffett has, which is that the book provides an emotional framework for how to think about investing. And all of Graham's central ideas really tie together. They all feed into each other. You know, one of his ideas is that a stock is not a piece of paper. It's not a ticker symbol. It's not a pulsing cursor or line on your phone. A stock is a piece of ownership in a business. Is the business good or bad? If the business is good, meaning that it generates growing amounts of cash over time, then in the long run, the stock will do well. And if the business is bad, in the long run, the stock will do badly. And, you know, the people who bought meme stocks in 2020 and 2021 looked only at the stock and ignored the business. I mean, you can't look at a company like GameStop or AMC and regard them as good businesses. They're just not. And you know, I and a bunch of my colleagues at the Wall Street Journal have had very angry arguments about people who then loved those stocks, and some of them still do. And I'm very sorry, those are bad businesses. They were good stocks in the sense that they went up. But in the long run, you can't make a good stock out of a bad business. And that ties right into one of Graham's other ideas, this wonderful metaphor of Mr. Market, who is the
lunatic.
Yeah, he's kind of he's the lunatic who lives next door to you, and like a lot of crazy people, most of the time he doesn't seem so crazy. He kind of seems normal. He's quiet, he keeps to himself. He doesn't really bother anybody, but then, you know, one day he's manic. You know, he's got his mania, and he runs to you and he says, "I'll buy your business." You give me any price, I'll pay it. And another day, when you actually want to sell your business, you go to him and you say, Mr. Market, I'm willing to sell. Are you interested in buying? And then he offers you some price that's ridiculously low because he's depressed. And understanding the nature of Mr. Market is very important. The stock market is not your master. It's your servant. And you should not let the stock market always tell you what your assets are worth. Sometimes it will be wrong. It was wrong in 1999. It was wrong in 2020 and 21. And, in maybe in some respects, it's starting to get a few things wrong now. And you have to be patient, and you have to recognize that if you're buying individual stocks, that you can't rely exclusively on Mr. Market's judgment.
You mentioned Warren Buffett beforehand, and it's widely known that Ben Graham and the intelligent investor were the backbone of Warren Buffett's financial culture before he went on to become the most legendary investor of all time, though Buffett's style of investing is quite different from that of Graham.
Mm-hmm.
The intelligent investor and Warren Buffett are two among the most misquoted phenomena in the entire financial ecosystem. There's always something you can pick from both to support whatever you mean. People try to emulate Warren Buffett and think that studying the intelligent investor is a way to become a great stock picker, who, by the way, Warren Buffett is not. Instead, why there will never be another Warren Buffett?
Yeah, so I wrote about this when Buffett announced that he will be retiring from his active role at the end of this year. I mean, he is turning 95.
Very young.
In August, yes. He's very young compared to Charlie Munger, who kept going until he was almost 100. So I think there's a few reasons for that, Ricardo. So the first is that I'm not sure most people understand just how obsessed Warren Buffett was and is about investing. I mean, this is someone who, when his children were young, he would take them to, Disneyland or, some amusement park. And while they were playing on the rides, he would be sitting there reading annual reports of, Warren Buffett was 100% focused every single waking moment of his life for, 80 years with the stock market and with individual companies. He before he invested in Anheuser-Busch, the big brewing company, he read its annual report and every quarterly report for 25 years. I mean, I estimated, and I think it's conservative, I estimated that Warren Buffett has probably read over 100,000 corporate financial reports in his career. It's a degree of obsession that almost no one else can imagine sharing. So that's the first thing. And, the second thing is that he had a structure to his investment management business that was unlike any other. He didn't run a mutual fund. He didn't run an exchange-traded product. He didn't run a hedge fund. He didn't manage money for outsiders after 1965. For most of his career, he ran Berkshire Hathaway as a holding company. It was a corporation that happened to buy other companies for its investing portfolio. So nobody could tell him what to do. He didn't have outside investors throwing money at him when the market was going up, forcing him to buy overvalued stocks he didn't want. And when the market went down, people couldn't take their money back because it was already in the company. And because of that, he never had to deal with cash flows, with external cash flows. All he had to do was take the internal cash flows generated by the businesses he was buying and put them to work. So he had no interference. He had no external problems from people coming and going. He had a board of directors who basically admired him and told him to keep doing what he was doing, which he did. So how many other professional investors, even today, after he has set that example for more than 60 years, nobody does it.
They have rules to comply with. If they have clients, they cannot have concentrated portfolios, for example. No mutual fund can have Berkshire Hathaway-like portfolios with 50% in one stock, as it was with Apple some months ago.
Yes, exactly. And so that's been huge. And then the final reason there will never be another Warren Buffett is, to duplicate what he did to match his investing return. You not only have to be brilliant, you not only have to be obsessed, you not only have to have that unique structure, but you have to start when you're 11 years old and keep doing it until you're 95.
Oh, easy job.
He's had some very good luck along the way.
Sure. What can we learn from Graham and Buffett? Because Buffett would tell anyone not to follow his example, but instead to stick to SPY or VO and let the market do their homework.
Well, to start with, I think that's a very good lesson. It's commonly misunderstood about Benjamin Graham that many people have tried to tell me that Benjamin Graham was opposed to index funds, that he thought they would be a terrible idea. And of course, if you're an active manager, if you're a professional stock picker, you have an interest in telling people not to buy an index fund, right? And many professional fund managers have argued with me and said, well, Ben Graham hated index funds. And I was like, no, actually, Ben Graham said index funds should be created because they would be a very good idea. And he started writing about this in the 1950s. And in a speech he gave in 1963 in San Francisco, he talked at length for a long time about the need for, he said there should be an index fund. And he right up until his death in 1976, he kept hitting that message. So I think that's an excellent thing for anyone to take away from both Graham and Buffett. But I also think the lesson you can learn from both of them is that it's okay to mix different kinds of investing in your portfolio. What I like to advise people to do is, put most of your money, almost all of your money, in an index fund. But if you feel the need to use investing partly as entertainment, then take a little bit of your money and buy some individual stocks with it. It can be very educational, especially for young people. You could also do it for your children, your grandchildren, younger members of your family or friends. And you'll learn about what makes a good business and what makes a bad business. And it's also entirely possible that you'll do very well. You might beat the market doing that. Now, you might beat the market by luck. Maybe you're just lucky. Maybe you don't actually know what you're doing, but you might beat the market anyway, in which case that would be a lot of fun, and you still would get useful education out of that. So I think most people should have most of their money in index funds, and a lot of people should have all of it. But there's certainly nothing wrong with owning some individual stocks or some specialized ETFs. It's totally fine. And it's okay to think of investing as a way to have fun, as long as you're not having fun with all of it.
They were both obsessed with the idea of intrinsic value and to not buy, I wouldn't say overvalued, but highly priced stocks, because future returns are obviously inversely correlated with the price at which you buy a security today. Now we are in a period where at least the US stock market is highly priced. So one advice would be to stick to the market, and the market will provide for itself. But on the other side, there are a lot of wise people talking about rising valuations for a very long time. So what is the right sweet spot, in your opinion, between sticking to a broad index of securities and considering the fact that, for example, the US stock market is trading at 23 times forward earnings at the time we are speaking?
Yeah. So I think the best way to think about it is that this is partly about the stock market and it's partly about you, right? How young are you? How valuable is your human capital? Investors in the US, and I think also in Italy, do not think nearly enough about their total portfolio. So your total portfolio, I would argue, consists of three components. So your financial portfolio is only one. That's your stocks and your bonds, your mutual funds, your ETFs, and that's the part of your portfolio that everybody thinks about all the time. But you have two other kinds of portfolios. You have a portfolio of physical assets. That could be your house, your apartment, your automobile, your furniture. Maybe you collect art or wine, or you have any other physical object that is valuable. And then the third component is your human capital, which is you. It's the future value of your labor income. What will I be doing between now and the day I retire that will bring me income? And your human capital is flexible. You can make it more valuable. You can go and get an MBA. Obviously, that was great for you, Ricardo. You ended up as a podcaster.
Unexpected consequence
but-
of the MBA.
Yes, but people can get a graduate degree. If you're a chemist, maybe you only have an undergraduate degree. You get a master's degree. You get a doctorate in chemistry, or you study another field, and you make your human capital more valuable. So when you think of whether the stock market is cheap or expensive, you also have to think about the other assets in the other parts of your portfolio. Is your real estate also expensive right now? Or do you live in a city where for some reason real estate is cheap right now? I can't think of any place like that, at least not in Italy, but there may be one. And in that case, that gives you a little bit of potential appreciation there down the road. That might be worth more. And if you're young and your human capital can grow over time, then you can afford to take more risk, because that will support your financial portfolio through a period of poor performance. So that's a very long answer, but I guess what I would say is the older you are, the larger the portion of your total capital is in your financial capital, because the value of your human capital shrinks as you get older, because there's less and less you can do to make it more valuable as you get older. But your financial portfolio should grow as you get older. So the idea is to have, as one shrinks, you want the other to grow. And that's the reason why young people should have most of their money in stocks. It's not that the stock market has more years to recover from a downturn. It's that your human capital has more years to grow. And the older you get, the more worried you should be that the stock market is overpriced. And I'm obviously, quite a bit older than you, so I'm more worried about it. But as long as you're a diligent saver and you have plenty of cash, in the long run, you should be okay.
Yeah, that's a great framework and a great lesson, because we are typically obsessed with that 1% of total return in our portfolio, and we forget that we can invest our time to get a better job, to make more money, to invest in ourselves, etc. And that matters much more in the long run than the stocks we picked years ago.
That's right. Investing in yourself, assuming you do it wisely, investing in yourself can have a much bigger impact on the value of your total portfolio than the investments you pick.
Now I'd like to connect two dots. The fifth principle in the preface of your commentary to the intelligent investor is the secret of financial success is inside yourself. And you already mentioned that you had a close relation to the late Danny Kahneman, at least since you helped him with his masterpiece, Thinking Fast and Slow. And I always find a lot of behavioral finance in your own writings. In your opinion, what are the most important aspects of our emotional human being that affects the success of our investment in the long run?
Well, I think it probably boils down to one simple thing, Ricardo, which is that people are very good at lying to themselves. If you wanted to fool me or I wanted to fool you, we could probably do it pretty easily. I could tell you some story that you would believe, even if I
would definitely believe.
made the whole... Yeah. And you could tell me some fake thing that I would believe. But we're nowhere near as good at fooling each other as we are at fooling ourselves. That's what human beings are really good at. I don't often make political comments, but I will make one in this case, which is if you think back to what happened in the United States on January 6th, 2021, when the supporters of Donald Trump invaded the United States Capitol. So it was broadcast live on television, I'm sure all around the world. In the United States, I think everyone with a television, a computer, or a telephone saw the entire thing. And today, there are millions of people who sincerely believe that what happened that day was a peaceful protest.
Crazy.
I mean,
self-deception at the highest level.
Yes, and so there's an old Marx Brothers movie. I don't know if you know it. I think it was Duck Soup, and
of course I do.
There's a scene where Chico Marx says to the woman, I think it's Margaret Dumont, he says to her in his, by the way, terrible Italian accent, who are you going to believe, me or your own eyes? And people saw this happen with their own eyes, and now they have convinced themselves that what they saw did not occur. So that's a very long way of saying that when we invest, our objective should be, let's get to the place where we can be honest with ourselves. And that is a lifelong effort, because every aspect of human nature will fight you as you try to do that. Because people are overconfident, they hate to admit mistakes, they lie to themselves, and when you combine all of these weaknesses of human nature, they combine to form a conspiracy. It's a conspiracy against yourself to prevent you from admitting the truth. And that's why when you meet someone who says, oh, I love investing, I'm really good at it, I beat the market, and then you say, can I see your returns? And they say, what do you mean? I said, well, you said you beat the market. Can I see some numbers? And they're like, well, I don't have any numbers.
But I know it for sure.
But how do you know you beat the market? Well, of course I did. And so if you go through life convinced that you're beating the market, when in fact you have no idea whether you're beating the market, you may be happier that way. That might make you happy because you're living in an illusion. You believe you're better than average when you're probably not. And that might be good for you in one sense. But in another sense, wouldn't you rather grow as a person? Wouldn't you rather get to the point where you can admit the truth about yourself instead of like looking at the television, seeing one thing, and then a couple of years later saying, oh, that's not what happened. So I think that's the challenge for investors is can you be honest with yourself? Do you want to be honest with yourself? And, to use another example from a movie, it's like an officer and a gentleman at the end, the speech, you can't handle the truth. And can you handle the truth? That's the question. And I would like investors to get to the point where they can handle the truth and they can just say, maybe I'm not that good at this, and maybe that's okay. Maybe I don't have to be. Maybe I should go play with my kids or watch the football game or go make pasta.
Great. I came to the conclusion that the equity premium puzzle can be solved by thinking that investing in stocks works because people have to go against ourselves, because we are not made to do what it takes to be a successful investor. You have to think long-term, you have to be humble, you have to be less overconfident than we usually are. And then the premium is paid because you have to struggle against yourself every single day you are an investor.
I think that's very true. I think, over and over again in my career, I've met people who talked about being a long-term investor. And it's really interesting, Riccardo. A lot of these people were professional investors. I remember it was over 25 years ago, reading the annual report of a mutual fund manager who talked over and over and over again about the importance of thinking long-term, being patient. At this fund, we try to be the ultimate long-term investors. I mean, it was almost nonstop bragging about investing for the long term. And then I turned to the statistical section of the annual report, and the portfolio turnover rate of the fund was 120%, which for some of our listeners, I'll explain, means that the fund held its average stock for 10, maybe 11 months at a time.
Less than a year.
Less than a year. And is that long term? I guess this person thought it was. And so many people who bought those meme stocks in 2021 talked about, they didn't just say they were long-term investors, they said they were hodling. And I don't know if you have that term in Italy, but it's a sort of, it's just like an online term that means hold on for dear life. Like, I'm going to buy this and I'm never letting go. And then, when those stocks went down 80 or 90%, they all sold. So it's the emotional challenge of investing is overpowering for a lot of people. And I think it's because if you haven't put in the hard work of being honest about yourself, with yourself, then it doesn't matter what you invest in, you're not really an investor. You're a visitor. You're a lot of people, they're just turistici, they're just passing through. They're taking a few pictures on their phone and an hour later they're gone. And you can't make money in the long run if that's how you invest.
I can't help but ask you now the hard question, which is about the current turmoil going on with the new administration. And on April the 2nd, which, by the way, is my birthday, so my birthday will always be marked forever with the Liberation Day events. But beside that, in the aftermath of that crazy day in the Rose Garden, you wrote a column in the journal mentioning the famous Templeton quote, "This time is different," are the 4 most dangerous words in finance. And you added that this time is not different can also be dangerous. So, what's your take? This time is different and some permanent damages are done for the US market, the economy, etc. Or this time is not different and things will recover and companies will find their way to overcome any issue and so on and so forth.
Yeah, so Mr. Market says this time is not different, right? We had that terrible decline in early April, and then by the end of April, it was all over. And, the U.S. stock market is quite close to its record highs again.
Yeah, it's the taco trade.
Yes, exactly. It's the taco trade. Hats off to Robert Armstrong for coming up with that term.
Totally.
I wish I had come up with that. Mine was Toto for tariffs on, tariffs off.
Yeah,
but I think his is better. So the market says this time is not different. I'm not so sure. I think it's at least a little different. It's hard to picture governments around the world negotiating a trade treaty with the United States, having full confidence that the treaty will be binding, that the treaty will endure. I think what was broken on April 2nd is the idea that the trade policies that gave us the global prosperity ever since World War II are the defining structure of the world economy. I think from now on, countries will be much more distrustful of each other when it comes to trade. And I think international investors have become much more skeptical about putting their money in either U.S. stocks or U.S. Treasury bonds. The dollar has lost some of its prestige. There still is no real substitute for the dollar.
Definitely not.
As the sort of basic currency for global trade.
I agree.
So countries around the world are kind of stuck with the dollar, but they're not very happy about it. And I think what all of this has done is it has introduced a level of uncertainty and maybe we could call it environmental risk that was not there before. The problem that I see is not so much that uncertainty and risk have been elevated. It's that Mr. Market is not reflecting that. And maybe that's how it's really different this time. Maybe this time is different because something has been broken. Confidence in the global system of trade, confidence in U.S. exceptionalism, those things have been broken, but financial markets have not really reflected that yet. And I think sooner or later, one of those things has to move to match the other. Either the political framework in the United States will change and the U.S. will go back to a more open system of trade as we had, up until April 2nd, or the price of financial assets needs to come down to reflect the fact that the system has sustained that damage. And I mean, when that will happen is impossible to predict, but it seems to me you can have one or you can have the other, but you can't really have both. Yeah, at least not for long.
Yeah, totally. About 15 years ago, you joined the Wall Street Journal after Jonathan Clements endorsed you to take over after he stepped down after more than 1,000 columns for the journal. Would you mind telling us about Jonathan Clements
Yes.
and what you are doing with Bill Bernstein and Christine Benz in his honor?
Yes. So for anyone who doesn't know, Jonathan Clements was the personal finance columnist at the Journal for many years. And when he left the Journal in 2008, he proposed me to as his replacement. And as I like to say, I did not replace him. I simply took a job that was available when he left, because Jonathan is irreplaceable. He's not only a brilliant writer and incredibly important thinker about financial issues, but he's also just a fantastic person. We've been friends for almost 40 years. And a year ago in May, Jonathan was diagnosed with a rare terminal cancer. And he's had many surgical procedures and other treatments. And his prognosis is not good. And I visited him last month, and we had a very, very pleasant day together, and lots of laughing and telling old jokes and stories. But a bunch of Jonathan's friends and admirers, of whom he has many, when we heard the news, a bunch of people approached him and said, "What can we do to honor you?" And several people said, "Can we create a journalism award in your name?" And he said, "Oh, please don't." The world has too many journalism awards as it is, which I would certainly agree with. And so Jonathan had a brilliant idea. He said, can you see if you can create a program that would take young people from poor families and give them a cash grant that they could invest in a Roth IRA. And, for our followers in Italy, this is a kind of retirement account that exists in the U.S. that has several tax advantages. And it's very commonly used to motivate young people to start saving. And so what he wanted to do was, let's see if we can take people who've never really participated in the financial markets because they either don't know about it or they just don't have any money and their families have no money. And let's see if we can bring them along. And so a bunch of us got together. We produced a book, which is an anthology of Jonathan's best columns. It's called The Best of Jonathan Clements, and it's available on Amazon. And the proceeds from the book and all the money that we're raising go to fund this program, which is being designed by JPAL, which is a behavioral economics research organization whose co-founders, Esther Duflo and Abhijit Banerjee, were recipients of the Nobel Prize in Economics in 2019. So we're working with some of the most talented, smartest economists in the world to try to come up with a program that will motivate these first-time investors to become lifelong investors, all in Jonathan's name. And we've raised over $300,000 so far. And we're very hopeful. We don't know if it'll work. It might fail. But we're very hopeful. And as Jonathan said to me, I won't see it happen, but you will. And he said, I hope it works. So we're very hopeful, and I think it's a wonderful legacy for him as somebody who always has been dedicated to helping other people through his work.
I highly recommend the book because you can read it in a couple of hours, and it's obviously smart, brilliant, and full of wisdom. But the most important thing is that it will make you laugh a lot. For example, when he says that the short sellers are like children pulling off legs from spiders, or other things like this to redefine the actual meaning of the financial jargon, that's absolutely brilliant. So highly recommended. Jason, thank you so much for this amazing and insightful conversation. It was a truly honor to host you here.
It was my pleasure to be with you, Riccardo. Thank you for having me.
Look forward for the next column in the journal with The Intelligent Investor.
Yes. Be there. Bye now.
Bye-bye. And that's all, folks. I hope you enjoyed yet another inspiring and thought-provoking interview with one of the true giants of financial journalism, and that, like me, you found some valuable takeaways to strengthen your awareness as investors. A heartfelt thank you to Jason Zweig for the time he generously shared with us, and of course to all of you for being here, sharing these special moments with me when brilliant minds like Jason's come to pass on their extraordinary wisdom. As always, I invite you to follow the podcast and turn on notifications on Spotify, Apple Podcasts, or wherever you are listening, and please consider leaving a 5-star review to support our work and help us keep bringing you the kind of guests who are truly qualified to answer the timeless questions: what really makes an intelligent investor? That's truly all for this episode, and I'll see you next Wednesday with another topic, right here, of course, on The Bull, your personal finance podcast.